Hey, what's going on, guys? It's Sal Bossio with Mortgage Universe, where real deals get done. So today I wanted to talk about the non-QM space. Non-QM stands for non-qualified mortgage. These are all the loan types and loan products outside of your traditional loans like conventional VA, FHA, and USDA, right? Usually the non-QM space is best for those that are self-employed that don't necessarily have the taxes, W-2s, pay stubs, right? When you're self-employed, lots of times, you'll have income in your bank statement, right? We can actually look at the bank statements for income. So we can do either 12-month bank statement, we can do a 24-month bank statement program. Bank statement loans are very popular in the non-QM space. The way that these are typically approved is there's a few ways that we can look at the income. The easiest way is if you do have a substantial amount of income, what they'll do is they'll basically look at your income and they'll cut it in half. They'll call it a 50% business operating expense ratio. And as long as we have enough income, even with cutting that income in half, it's very, very simple to do these loans. Now, sometimes we need more than 50%. Sometimes we need more than the 50%, basically cutting your income in half. With a CPA letter, okay, so a certified CPA or an enrolled agent, in some cases we can even use a tax preparer, which is great because a lot of people will have a tax preparer but not have an actual CPA. We'll be able to then have them write a letter, after they review your bank statements and after, we give them a little bit of information. They'll basically be able to write a letter that states, no, my client's operating expense ratio is only 30%, is only 20%, is only 10% in some cases. So that will allow the underwriter to give us credit for more income and not just simply slice it in half. So if you have a 30% expense ratio, well, now we're getting 70% of your income through your bank statements instead of only 50%. If the CPA says there's only a 20% expense ratio, well, now we've got 80% of your income, and so on. Some lenders will go down to as little as 10%. So these are really great loans. They're not that difficult. In some cases, they're actually easier to get approved than your standard, conventional and FHA loans because you don't even have to run an AUS, an automated underwriting. Now, with the bank statement loans, if you're doing a purchase, you do need, typically, they want to see 20% down. However, there are lenders that will do as little as 10% down as well. It is a little bit of a higher rate, but with these bank statement loans, the fact that we're getting creative to get you approved, to get you in a home, they do want you to have a little skin in the game, right? So they're risky loans for that reason, but 10% down is usually the minimum. I've done several of them. And usually with a bank statement loan, they want you to have at least a 660 credit score. Now, I've seen them go down to 640. They're tougher. The rates are higher, of course, but 660 would typically be the minimum. However, for a 10% down bank statement loan, almost always they want you to have a 700 credit score. Again, I have over 200 lenders that we look at, so we're going to make sure that we choose not just the lender that gives you the best rate, but obviously the lender that's going to get this done, that's going to get you to the closing, that's going to get you to the finish line, obviously. The next most popular one would be considered a 1099 loan. So we can actually, believe it or not, get you approved using your 1099 income. And I have lenders that will make this really simple and just basically go off of a 10% operating expense ratio. So what that means is you're getting 90% of your income credited. You're getting credit for 90% of your income and not even need a CPA letter or involve a CPA at all. These are amazing loans. I'm doing one right now. It was approved in 48 hours. The only thing we're waiting on now is an appraisal. Very, very, really great, a really great product. Typically with the 1099 loans, you just need to show your most recent 1099. If it's a 1 year, we only need 1 year. If it's 2 year, we need 2. The pay stubs that are associated with your income. So typically when you're 1099, you get some version of a pay stub that shows, hey, if you're paid twice a month, this is for this pay period, this is for this pay period. It's really not much at all. That's pretty much it, other than all the other standard mortgage documents, mortgage statements and stuff like that. But yeah, those are really great loans. With those, again, typically 20% down, although there are some lenders that will allow you to do 10%.